Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode, we're going to talk about mortgages underwater, what it means for Canadians, what does it mean for the real estate market. Stay tuned, you don't want to miss it. For those watching on the Team Sessa YouTube real estate channel, once again, thanks for your comments. Don't forget to leave those comments in the comment section below. And while you're down there, don't forget to smash that like button, hit the share button, and make sure you're subscribed to the channel and hit that notification bell so you get notified every time we post a new video. And if you want to book a free consultation with myself or Santo to talk about mortgages or real estate, you can do that in the description box as well. But now, back to the video. Insured mortgages are in the news once again. And earlier this week, we heard from some of the major insurers, the three major insurers in Canada, CMHC, Canadian Mortgage and Housing Corporation, Sagan, and Canada Guarantee, that some of their mortgages are actually underwater. And this may be eerily familiar to what had happened at the onset of the pandemic when we saw and heard the same news about the potential for home prices and their decline and what it could mean for insured mortgages. Now, why is this important? Well, if we take a second and look at who's insuring the mortgages and who's providing the financing for them, it can give us a better understanding of what is actually unfolding in the mortgage and real estate marketplace, at least from my perspective, and you can agree or disagree. Let me know in the comments sections below. So if we look at insured mortgages here in Canada, CMHC being the biggest player, a government-backed entity that provides insurance, default insurance to Canadians purchasing a home. And let's not kid ourselves, even Sagan and Canada Guarantee to some degree are also backed by the government. And anything backed by the government, well, essentially is backed by the taxpayer. So you and I would be potentially paying for any bad loans that could occur. Now, the insurers and the banks do not want to see obviously defaults tick upwards, and they don't want to force Canadians into selling their homes if they can avoid it. And avoid it they will, because over the last few months, we've definitely seen some significant changes in the way the banks are accommodating individual clients that are facing exceptional circumstances. If you recall, we talked about the federal budget 2023 and some of the guidelines that are being penciled in to help the banks by providing them with guidance and government support to ensure that they can extend amortizations or add these interest costs back to the principal amounts, or providing very catered services to these individuals that might find it financially difficult by ensuring that they don't pay extra interest charges, so on and so forth. As you can see, the banks had basically already been doing this, but now it's sort of penciled in. On top of that, we saw this occur many, many months ago with insured mortgages, and banks were already doing this behind closed doors to ensure that their mortgage portfolio remains positive, or remains healthy and functioning and capitalized, and that they can continue to lend money. But then OSFI stepped in, which is the Office of the Superintendent of Financial Institutions, and said, wait a minute, banks, you need to make sure that you adhere to the guidelines and you have a significant pool of money to back yourself up in the event these mortgages do not perform, in case these clients go into default. In case, for example, these individuals are forced into a power of sale, these loans go bad, you can't sell the house at the same price and you're short. So many different components obviously were discussed at these meetings, and we are still waiting on OSFI to come out with their current changes that they should be announcing sometime very soon. They concluded their meetings, I believe, last week, and we will be hearing about them very shortly. And if that's something that interests you, you want to stay up to date with what's happening, well, don't forget to hit the like button, hit the notification bell, make sure you're subscribed to the channel, and if you learned something, share the video. So obviously we have OSFI, we have the banks conducting themselves in a particular manner. A lot of what I want to call, magic happening here. And all this magic, if you take a step back, is actually propping up the housing market. It's ensuring that Canadians can stay in their homes a little bit longer, kicking that can down the road. Now, don't get me wrong. If you're a Canadian, you're finding it financially hard, maybe something happened catastrophically, and as long as you're able to make these payments, well, you can stay in your home. it sure beats for some Canadians the alternative of having to go rent in this market, especially when you consider, at least in Toronto, that rents are over $3,000 on average. So some Canadians' mortgages might not even be that high, even with the higher interest rate costs that we've seen by the Bank of Canada, especially for variable rate mortgages, where the Bank of Canada has increased 8 consecutive times since March of 2022, right? So this is a big problem. So the bank's doing all this magic. We have Canadians staying in their homes longer, which is showing signs when we look at the inventory levels. Why are inventory levels so low? Well, obviously we can have a conversation about that. There's many different perspectives on it. But for example, we've been talking to clients, even those who are in insured mortgages are looking, saying, look, home prices have come down 15%. If I sell my house today, I might not even make the money back that I put into it. I might be short, and we'll go through a quick illustration in just a moment about a particular case that we're working on. But you have these individuals that can't really sell their home. They can make their mortgage payments. They're waiting for potentially the market to rebound. Then you have individuals that are saying, well, if I sell my house now, what am I going to buy? There's really not that much inventory in the market. And the homes that I am looking at, well, there's very slim pickings. There's multiple offers once again, and these bidding wars. And I just went through it not too long ago. You know what? Thank you, but no thank you. We're opting not to participate in that. So there's a lot of different push and pull factors in that particular market. In addition to all of this, something that we've talked about and something that you may be aware of is obviously these immigration levels that we are seeing here in Canada with permanent residency students and foreign workers, temporary workers. I mean, these are definitely individuals that are taking from the existing short rental market, limited inventory. I always say to clients, I said, look, if you're a first-time home buyer, why is this so challenging? Obviously, the factors, the cost, finding that wonderful home that checks off as many boxes as you possibly can at your price point. But more importantly, you're pulling from a limited inventory base. If you're a move-up buyer, well, you have a deposit and a return, a debit and a credit, because you're pulling from the inventory by buying, and then you're selling by reintroducing it. So there's so many different components. One other thing we were talking about several months ago is home builds, new construction builds for single-family homes, this middle area of homes that is lacking in this country. So we start to see that builders' confidence is down. A lot of developments are not actually happening. Some banks are feeling that pressure because they haven't been able to fund new construction developments because finally the government walked back this foreign buyers ban. So now that we've sort of covered some of the sentiment of why insured mortgages are important and what it looks like to Canadians who might be looking at this news data, these headlines saying, hey, this could be a good sign for us to go out and buy. Well, maybe you want to take a second and take a look, obviously, because some of the things we talked about, right? Are these things actually indicators to bring more inventory to the market, or is it going to hold people back? So let's take a look at this particular example of an individual who would be in a position to sell their home, but due to the circumstances of their mortgage being underwater, well, what it actually would look like. So I want to go over this very quickly. On the left side, we'll see the purchase. On the right side, we have the actual sale details. And as you can see, the individual secured a 5-year fixed mortgage at 1.79% from a monoline lender, which will come into play in just a moment. The home purchase price at the time back in 2021 was $700,000. They put $45,000 down. Their insurance premium totaled to $26,200. Total mortgage amount with that insurance premium was $68,200. And by the time they paid their closing costs and their land transfer tax and their legal fees, they were basically at $55,571. Luckily, the individuals had such a good interest rate. Unfortunately, their home price had came down about 10% based on the sale price of their home. Now, they sold the home for $630,000. The real estate commissions that ended up being paid out were around $31,500. Tax on the sale of their home, by the time they look at their current mortgage, luckily, because that rate was so low, a lot of it had gone to principal, but their mortgage was still $637,164.83. As you can see, between the sale price of their home and their current mortgage amount, well, right there, they're underwater. not to mention the real estate commissions, legal fees, and the penalty that they ended up paying, which was $2,800. Luckily, as I said, it was with a monoline lender. If this was with a major bank, that penalty would have been a few $1,000s more when we ran the scenario for them. And I usually run those for ourselves just to sort of give an understanding for what they would look like. And when we actually estimated that entire cost of their shortfall, it was around $47,568.33. These individuals, unfortunately, due to their situation, they had to sell their home. They were actually bailed out by some family members to get out of their home for $50,000, but not many individuals may find themselves in this particular scenario. And the reason why we're doing this or talking about this particular scenario is because the clients have come to me with an option. What are the solutions? Like, because of the sale price, they could have waited a little bit longer, but the clients unfortunately could not. This was a very particular situation for them. They were going through separation, so they could not really keep the house or rent it out or anything like that. It was just literally a marital breakup. These were the hardships that they had faced. And as you can see, the clients unfortunately, were underwater. Maybe some individuals out there may find themselves in a very similar situation, and maybe you're looking at your opportunities and what those costs would be in your particular scenario. And if you find yourself asking these questions, well, in the link below in the description box, you'll find a link to our mortgage app. It is free to download. You can download that, and there are refinance calculators and other tools available to help you sort of run these scenarios, because if you're in this position, you want to make sure that you're fully aware. When the client had originally done their pro forma on what the cost would be, they were estimating around $25,000, but by the time they added in, they forgot about some of the HST on the tax, they forgot about the penalty, the legal fees. They had missed all that information, and they would have probably not sold the house. They said to me, like, "Ant, I wish we would have known that before we put the house up for sale. We probably would have, maybe extended things a little bit longer, tried to work things out." But obviously, helping clients is what we try to do best here at InTouch Mortgage Solutions, and running these scenarios to help our viewers and our consumers illustrate the differences. So if you found this video helpful, we invite you to hit that like, that share button with someone maybe who would benefit from this content. Don't forget to subscribe to the channel and hit that notification bell so that you can get notified every time we post a new video. But we'll leave the video here, wishing everyone a wonderful Friday and an even better weekend ahead. Thanks for clicking. Thanks for watching. Have a great weekend.